Something very unusual is happening in the XRP market right now, and most people are completely missing it. While social media is busy arguing about short-term price moves, XRP is quietly disappearing from public exchanges at a speed we have not seen in years. This is not hype. This is not speculation. This is a structural shift happening deep inside the ledger itself. And once you understand what is really going on, you will realize why the current price does not tell the full story. Welcome back to We Are Cosmic, the channel where we break down finance and cryptocurrency from an expert, data-driven perspective without noise, without hype, and without confusion. If you are here to understand what smart money is doing before the headlines catch up, you are in the right place. Make sure you stay until the end, because what we are about to discuss is not about short-term trading. It is about positioning before scarcity becomes obvious to everyone. Right now, XRP is going through a silent migration. Tokens are leaving public exchanges and moving into private custody wallets at an accelerating pace. This means fewer coins are available to be sold on the open market. While most traders are staring at daily candles and reacting emotionally to volatility, the real shift is happening at the supply level. This is not a normal price recovery. This is a redistribution of XRP supply from weak hands to strong hands. The data tells us something very important. Over the last 48 hours alone, the XRP ledger recorded more than 25,000 new wallets entering rich list tiers. This is one of the densest accumulation events we have seen since the 2021 bull market. And no, this is not just a few whales quietly stacking in the dark. This movement is happening across the entire ecosystem. Small retail holders, mid-level investors, and large institutions are all accumulating at the same time. This kind of behavior only happens when the market starts viewing price very differently. The $2 level is no longer being treated as a point to take profits. It is being treated as a long-term entry zone. Every new wallet that enters the rich list represents XRP that is effectively removed from the sell side of exchange order books. Once coins move into private wallets, they stop contributing to selling pressure. What we are seeing is a broad increase in long-term conviction. As the XRP network matures, more participants are choosing to hold rather than flip for quick gains. This is visible through total wallet growth. The number of people willing to hold XRP long-term is now outpacing those looking for fast exits. This kind of foundation building usually takes years. XRP is doing it in months. In early 2026, the total number of unique XRP wallets officially crossed 7.5 million. This milestone matters more than most people realize. A network with millions of independent holders becomes far more resistant to sudden crashes. When ownership is widely distributed, no single entity has enough power to collapse the market with one sell order. This is how real price floors are built. Think about it this way. When millions of wallets are holding XRP, selling pressure becomes fragmented. It takes an enormous amount of coordinated selling to push price down meaningfully. That is why previous resistance zones start to fade into history. What forms instead is a psychological and structural floor supported by real conviction, not hype. One of the biggest misunderstandings in crypto right now is what it actually means to be early. Many people still think holding a few hundred XRP automatically puts them in a strong position. That idea is outdated. The XRP rich list is evolving rapidly, and the requirements to enter the top tiers are increasing faster than most retail investors realize. The data is very clear on this, and it tells a story that is both uncomfortable and revealing. As XRP's price establishes itself above the $2 level, the cost of participation is rising in real time. Wealth inside the XRP ecosystem is not static. It is relative. As price increases, the number of tokens required to maintain status inside the network also increases. This is why the rich list matters. It is not just a leaderboard. It is a real-time reflection of market conviction and long-term belief. Right now, ledger data shows that to be in the top 10% of XRP holders, you need roughly 2,350 XRP. To enter the top 1%, the requirement jumps dramatically to around 50,000 XRP. These numbers are not opinions. They are mathematical outcomes of supply distribution. And as price continues to rise, these thresholds will only move higher. This creates a very important psychological shift. Investors are no longer buying XRP casually. They are competing for position. People are not just buying because they expect price appreciation. They are buying because they want to secure a rank within the network before it becomes unreachable. This behavior signals long-term commitment, not short-term speculation. Think about how different this is from previous cycles. In the past, XRP was considered cheap, and many investors believed they had plenty of time. A side hustle could easily buy thousands of tokens. That era is ending. Buying 1,000 XRP today costs around $1,750 compared to roughly $500 just a year ago. That change alone has already priced out a large portion of hesitant participants. Now here's where it gets even more interesting. When we analyze who is actually driving accumulation during this January 2026 rebound, the data shows something unexpected. Yes, whales are still accumulating, but they are not the most aggressive group. The fastest growth is coming from mid-tier investors, those holding between 10,000 and 100,000 XRP. This group is growing faster than whale wallets by approximately 12% during this rebound. That tells us something critical. These are investors graduating from retail behavior into professional behavior. They are absorbing supply that used to sit on exchanges. They are not trading emotionally. They are positioning strategically. Mid-tier holders form the backbone of sustainable price action. They are large enough to matter, but diversified enough to avoid panic selling. These are not paper hands chasing a 20% move. These are investors who understand scarcity and are willing to hold through volatility. This is exactly how strong market structures are built. The XRP Rich List is no longer just about who has the most tokens. It has become a map of a new financial hierarchy forming in real time. Each tier represents a different mindset. At the top, institutions and whales secure long-term dominance. In the middle, professionals lock in strategic positions. At the base, millions of retail holders create stability. This layered structure is powerful. It makes XRP far harder to manipulate than in previous cycles. When price pulls back, it is met with demand from multiple layers of conviction. That is why corrections are becoming shallower and recoveries faster. The most important takeaway here is simple. Wealth inside the XRP ecosystem is becoming more competitive, more expensive, and more permanent. The longer someone waits, the higher the barrier becomes. And once scarcity fully sets in, moving up the rich list will require significantly more capital than most people expect. By now, it should be clear that XRP is not just moving in price, it is moving in structure. Over the last few months, the network has grown to over 7.5 million unique wallets, and this is not just a number. This milestone represents a profound shift in market dynamics. When millions of holders are actively participating, the market becomes far more resilient to sudden shocks. No single whale, or even a handful of whales, can crash the price as easily as before. This is the foundation of what I like to call a structural price floor, and in XRP's case, that floor is forming right around the $2 mark. Here's why it matters. In past cycles, a price floor was just a psychological barrier, a number on a chart that traders hoped would hold. But with XRP, the floor is being built by real wallets with real conviction. Every wallet that enters the rich list or accumulates in a private address is effectively removing tokens from circulation. That reduces liquidity on exchanges, making it much harder for sellers to move large amounts without impacting price. In short, the more wallets actively holding, the stronger the floor becomes. The numbers show just how extraordinary this accumulation is. In January 2026 alone, over 25,000 new wallets joined the XRP Rich List, spanning retail investors to high net worth participants. This mass entry is not speculative trading. It is a deliberate effort to secure positions before supply becomes scarce. When millions of holders collectively decide to hold, the market no longer reacts primarily to price, it reacts to participation and scarcity. This structural floor also changes how we should interpret volatility. Most people see short-term fluctuations and panic, thinking that the market is unstable, but the reality is that the base layer of holders absorbs that volatility, smoothing out corrections. It is a form of network insurance. Retail participants, mid-tier investors, and whales all contribute to a network where sudden drops are far less likely to destabilize the ecosystem. Another important factor is order book behavior. With so much accumulation happening privately, the sell side of exchanges is thinning rapidly. Data shows that liquid XRP reserves on major exchanges have dropped by 18% since the start of the year, even as the price established itself above $2. When demand meets shrinking supply, the natural result is upward pressure. The quiet accumulation we are seeing is essentially preparing the market for the next breakout, and the $2 level becomes a launch pad for everything that follows. And it's not just retail wallets doing this. Institutional involvement is adding another layer of support. Spot XRP ETFs and institutional inflows are removing hundreds of millions of XRP from the public market, locking them in cold storage. For each token a retail investor buys, institutions are effectively taking 10 off the board. This isn't temporary, it's a structural scarcity event, turning the $2 level into a psychological and functional fortress. So, what does this mean for anyone watching XRP right now? It means that timing and preparation matter more than chasing FOMO. The $2 floor isn't just a number on a chart, it's a representation of millions of holders' conviction, growing scarcity, and coordinated accumulation. Those who recognize it and secure positions now are setting themselves up to benefit from the next phase when supply becomes extremely tight. Now that we understand how the $2 floor is forming, it's time to look at the other side of the equation, institutional demand. This is where the real game changes. For years, crypto markets were dominated by retail participants, traders chasing short-term gains, social media hype, and speculation. But in early 2026, XRP has entered a new era where institutional capital is actively shaping the market, and the effects are enormous. The primary driver of this shift is the rise of spot XRP ETFs. These funds allow Wall Street and professional investors to buy XRP directly without touching exchanges. Unlike retail purchases, tokens bought through these ETFs don't circulate. They go into cold storage to back the fund, effectively removing them from the market. In January alone, institutional inflows reached $1.7 billion, taking nearly 700 million XRP out of circulation. This is a supply shock of unprecedented scale. Think about that for a second. For every token a retail investor buys, institutions are removing 10 tokens from the market. This imbalance between demand and supply is exactly what fuels strong, sustainable price growth. When fewer coins are available to sell, any upward pressure on price is amplified. That's why we are seeing XRP hold above $2, even while other cryptocurrencies experience more volatility. It's also worth noting that the institutional accumulation is silent but extremely effective. Unlike retail traders, institutions don't chase daily headlines. They operate based on long-term strategy, quarterly allocation targets, and adherence to investment mandates. Their buying doesn't create short-term hype, it creates structural scarcity. Every token locked into an ETF is one less token available to suppress the price, and this makes XRP increasingly difficult to manipulate. The supply squeeze is compounded by the shrinking reserves on exchanges. Data shows that the amount of XRP available on centralized exchanges has dropped to multi-year lows, even as the price stabilizes above $2. This divergence is a classic signal. When demand continues to rise but supply is disappearing, the market must adjust upward eventually. Essentially, the ecosystem is self-correcting through scarcity. Another fascinating aspect is how this institutional pressure interacts with retail accumulation. The 25,000 new rich list wallets aren't just competing among themselves, they are competing with institutions controlling billions of dollars. This creates a unique scenario. The market is being defended from below by millions of small and mid-tier holders, while simultaneously being absorbed from above by institutional players. The result is an extremely tight supply environment where selling pressure is minimal and price resilience is maximized. What this means for investors is critical. Timing, wallet security, and position sizing now matter more than ever. With institutions moving quickly, waiting too long could mean missing the chance to secure positions before scarcity accelerates. Retail investors need to understand that this is no longer just a game of trading sentiment, it is a battle for ownership in a shrinking pool of available XRP. By now, it should be clear that XRP is entering a unique phase. We're no longer just talking about short-term trading or speculative swings. The ecosystem is being reshaped by a combination of mass retail accumulation, mid-tier professional growth, and institutional absorption. This means that the rules of the game have changed. If you want to capitalize on this moment, you need a strategy that goes beyond simply buying and holding. The first principle is redundancy. During periods of high volatility and supply squeeze, relying on a single exchange or wallet can be extremely risky. Exchanges can experience technical glitches, halt withdrawals, or face unexpected liquidity issues. If you are caught on a single platform during a supply shock, you could miss critical opportunities, or worse, be unable to access your funds when needed. This is why many professional traders and strategic retail holders maintain multiple KYC accounts across different exchanges. Redundancy ensures that you are never locked out of the market when the big moves happen. Second, focus on secure wallet management. XRP that is left on exchanges is vulnerable to selling pressure, hacks, or outages. Moving a portion of your holdings into private wallets or cold storage protects your position and contributes to the broader scarcity that is driving price resilience. Remember, every token removed from circulation strengthens the $2 floor and sets the stage for higher price levels. Smart holders treat scarcity as an asset itself. Third, stay informed in real time. Markets are moving fast, and the combination of retail accumulation and institutional inflows means conditions can change hour by hour. Platforms like Discord communities, whale alerts, and verified analysis channels give you a front row view of where smart money is moving. Being aware of large accumulations, sudden spikes in wallet activity, or ETF inflows allows you to anticipate supply shocks before they hit mainstream attention. This transforms you from a reactive participant into a proactive strategist. Another key principle is understanding supply dynamics. XRP is mathematically capped, and the circulating supply is further restricted by institutional grade lockups and escrow discipline. For example, Ripple has returned hundreds of millions of XRP to multi-year escrow accounts, neutralizing scheduled releases. This means that scarcity isn't accidental, it is built into the system. When you combine this with the 25,000 new wallets actively pulling tokens off exchanges, the market is entering a period where demand far outpaces available supply. One practical takeaway from this is that every token you secure today becomes exponentially more valuable tomorrow if accumulation rates continue. Whether you are a small retail participant or a mid-tier investor, understanding the supply-side mechanics is more important than predicting short-term price movements. This is the difference between being caught chasing a breakout and strategically positioning yourself to benefit from it. Lastly, patience is critical. The average holding period for retail wallets has increased to over 480 days, showing that long-term conviction is growing. Unlike past cycles, this accumulation is not speculative hype. It is a deliberate, coordinated effort by millions of holders to secure their positions before liquidity becomes extremely scarce. The market is moving from an accumulation phase into what I call a lockdown phase, where XRP becomes increasingly hard to acquire at reasonable prices. What does the next phase of the XRP market actually look like, and how can investors position themselves to benefit while managing risk? The data tells a clear story. XRP is entering a phase of structural scarcity, and the combination of retail conviction and institutional demand is setting the stage for significant price appreciation. First, let's discuss liquidity and supply dynamics. Over the last month, Ripple returned 700 million XRP to escrow, effectively reducing the monthly release of tokens. At the same time, 25,000 new wallets joined the rich list, pulling additional XRP off exchanges. These two factors together are creating what analysts call a supply-side shock. Simply put, there are fewer tokens available for sale while demand continues to rise. In a market like this, price does not stagnate. It adjusts upward to reflect scarcity. Institutional adoption amplifies this effect. Spot XRP ETFs and other professional-grade funds have been absorbing tokens at a rate that dwarfs retail buying. January 2026 alone saw over $1.3 billion in institutional inflows, removing nearly 700 million XRP from circulation. Unlike retail purchases, these tokens do not return to the market for ordinary trading. They are locked away, backing ETFs, or held in cold storage. This is a long-term structural change to liquidity and creates a scenario where supply cannot keep up with growing demand. This leads to one key insight. The $2 floor is not just psychological, it is mathematically and structurally supported. When you combine retail accumulation, mid-tier professional investors, and institutional inflows, you create a market environment where selling pressure is minimized, and even small increases in buying demand can have an outsized effect on price. It is a textbook example of scarcity driving value. Analysts projecting midterm targets are already suggesting potential $3.90 to $8 breakout levels as the ETF supply squeeze intensifies. These estimates are based not on speculation, but on careful modeling of liquid supply versus accumulated wallets, institutional inflows, and historical price behavior under similar scarcity conditions. While nothing in crypto is guaranteed, the underlying mechanics point to a highly favorable environment for those who are already positioned. For retail and mid-tier investors, preparation is essential. Maintaining multiple wallets across exchanges, securing XRP in private or cold wallets, and monitoring real-time whale activity are all strategies that protect your position. Those who are already part of the rich list or who secure their spot now will benefit the most as scarcity tightens further. Those who wait risk being priced out and forced to chase at much higher levels. Another point worth noting is the psychological effect of scarcity. As XRP becomes harder to acquire, holding becomes increasingly attractive. Retail participants are effectively learning the value of long-term conviction. Small and mid-tier wallets now collectively hold a larger portion of circulating supply than in previous cycles, and this decentralized accumulation makes the market far more resilient. The network is no longer dominated by a handful of whales. It is supported by millions of investors who are committed to holding. Finally, let's talk strategy. The era of buy low, sell high is evolving. Today, success in XRP depends on timing, preparation, and understanding supply mechanics. Whether you are a small investor or a professional, the focus should be on securing positions before liquidity shrinks further, diversifying holdings across exchanges and wallets, monitoring institutional inflows and rich list movements. Remaining patient, understanding that the market is shifting from volatility-driven trading to scarcity-driven value. In conclusion, XRP in 2026 is no longer just a volatile cryptocurrency. It is a digital asset moving towards structural scarcity with a resilient $2 floor, strong retail participation, and massive institutional backing. Those who understand these dynamics and act strategically now are the ones who will define success in this new era of crypto markets. The future isn't just about the next price spike, it's about positioning yourself in a market that rewards foresight, conviction, and preparation.